Canada Day was a few days ago, and though the fireworks have faded, in honor of my homeland, we're bringing you a video on our favorite no-hassle way to easily invest in Canada for big returns. Hey, I'm Lorianne, the CEO of Dow Janes and fellow native of Canada.
And I'm Britt, co-founder of Dow Janes, money coach and investing enthusiast. If you want more tips on how to take control of your finances and build wealth, be sure to subscribe and hit the bell so you don't miss future videos.
All right, before you start investing, the first thing you should know is that the basic principles of investing apply no matter where you are investing, whether you're in America, in Canada, or any other country. So if you have any questions about investing, feel free to look at some of our other videos. Now, before we get started, here are 5 guidelines to make sure you are prepared and ready to invest. Number 1, don't invest until you've paid off all of your high interest rate debt. This is any debt that has an interest rate over 7%, and almost all credit cards fall into this category. The reason I say this is because stock investing typically has an average return of about 8 to 10%. So if you keep high interest rate debt and start investing, you'll always be paying more in interest than you're going to make from your investments. Number 2, we don't recommend investing in single stocks. Investing in single stocks is quite risky. It's smarter to invest in ETFs or index funds, which provide instant diversification to your investment portfolio and mitigate the odds of you losing money. Number 3, avoid paying fees. We recommend paying no more than 0.3% of fees, aka expense ratios, in your investments. Number 4, keep your investments for at least 5 years. When the market dips, people tend to panic and pull their money out, and this is the most certain way to lose money. You don't want to invest money that you are not willing to leave alone to grow for at least 5 years. And on a related note, number 5, start investing as soon as you can. Your investments rely on compound interest to grow, and time is the most essential ingredient of the compound interest formula. The longer you hold the investments, the more money you are likely to make.
Thanks for those reminders. Really helpful for anyone who's getting started investing. So now we're going to talk specifically about how to invest in Canada. The first step to investing is to open a brokerage account. In the US, we talk about Vanguard, Schwab, and Fidelity a lot. In Canada, you have different options. You may actually already have a bank account with one of these banks, and now you'll want to open a brokerage account. Here are some examples of online brokerages in Canada: BMO, CIBC, HSBC, RBC, and TD. Next, you want to decide on your asset allocation. That is, what % of your portfolio do you want to be in stocks versus bonds? Bonds are a great investment because they aren't very risky. But stocks offer a higher reward. By investing in a mix of stocks and bonds, you can manage the riskiness of your portfolio. If you're young and you have a long time horizon to keep your money invested, or if you have a higher risk tolerance, you generally want to be invested heavily in stocks. Think 80 to 90% of stocks in your portfolio. On the other hand, if you're closer to retirement, or if you know you'll need to take your money out of your investments in 5 to 10 years, or if you're a more conservative investor, then you'd want to have a ratio closer to 65% stocks, 35% bonds in your portfolio. So once you've decided your asset allocation, we get to step 3. Now you have a choice. You can either create your own portfolio out of ETFs or index funds based on your asset allocation. If you want to do that, go watch our other YouTube video on ETFs to see exactly how. But this video is about the easiest and simplest way to get invested as a Canadian. And luckily, something called asset allocation funds already exist in Canada to make this really easy. So what is an asset allocation fund? It's a fund that is made up of a variety of ETFs to create a specific overall asset allocation. So different brokerages like BMO, Vanguard, and Fidelity each have their own asset allocation funds. And luckily, they all use the same names, so it's really easy to compare across the brokerages. One thing to note, at Vanguard and BMO, they are called asset allocation ETFs, while at Fidelity, they're called all-in-one ETFs, but they are essentially the same thing. And each one has a different name based on the asset allocation, that is, the percentage of stocks and bonds in the fund. Some of them are called conservative. That refers to 40% stocks, 60% bonds. There are some funds that are called balanced. That type of fund would have 60% stocks, 40% bonds. A growth fund would have 80% stocks, 20% bonds, and an all equity ETF would have 100% stocks. You may also see something called an income ETF. This is generally made up of 50% stocks, 50% bonds, and primarily optimizes for consistent income over time rather than significant growth or capital appreciation. And this is generally used by people once they retire. Vanguard and BMO have a few additional ETFs beyond the ones I mentioned. For example, BMO offers a balanced ESG fund, which means the assets are selected based on ESG ratings, which stands for environmental, social, and governance. It's one way to screen for companies that are acting responsibly in those areas. Vanguard also offers an asset allocation mutual fund called the Global Balanced Fund, which is made up of individual companies rather than ETFs and has a higher expense ratio as a result. So while there are a lot of benefits of asset allocation funds, I do want to talk about some of the downsides. So some of the downsides are that your options are limited. Say you wanted to invest in 70% stocks and 30% bonds as opposed to 80-20. That exact breakdown might not be an option in the asset allocations that actually exist today. So you are limited in what you can choose. You also don't have any control over what you're actually invested in. Say you wanted to invest in emerging markets, or say you really believed in the future of pharmaceuticals. This approach doesn't allow you to pick and choose. However, you could choose to invest 90% of your portfolio in an asset allocation fund and then use 10% of your portfolio to place a few bets based on what you believe in. So how should you choose your fund? 1, know the asset allocation you're looking for, the percentage that you want in stocks based on your age, your level of risk appetite. Then find the name of that fund with that asset allocation. Like I mentioned before, growth, balanced, conservative, for example. Then you'll want to look up 2 to 3 funds that match your asset allocation. So a fund at Fidelity, a fund at Vanguard, a fund at BMO. And compare the management fees across the different funds. Then you'll want to look at historical performance of these funds. Did one of them really outperform another? Then choose one. You really can't go wrong. Just choose one as soon as possible because the sooner you get invested, the more you have to gain.
Whether you live in the Great White North or the beaches of California or the mountains of Europe, investing is one of the best ways to build wealth. And it's really not all that different no matter where you live. If you want to learn more about our signature system that has helped thousands of women plus to pay down debt, build wealth, and take control of their finances, then check out our free masterclass on building wealth as a first-time investor. In it, I share the story of how I went from $40,000 in debt to making thousands of dollars from my hands-off investments every month. Go check that out. I'll put a link in the description below. Thanks for watching and hope you had a great Canada Day.